what is going to happen with the stock market in 2024. I'm D.H. Taylor. This is my channel, Stock Market Analysis and Stock Options, and I wanted to put together my projections 2024 stock market analysis and projections. Now, for anybody who's been following me for any length of time, if you'll recall my last year's 2023 stock market analysis, my projections for 2023, I nearly nailed it almost precisely. Basically saying all through the springtime, we'd see some movement upward, flat during the summer, then selling off in the fall. Of course, we've rebounded since then. The big story for stock market analysis right now is finding out what's going to happen with interest rates and the economy beyond that. So 2024 stock market analysis entails a lot of looking at the numbers. First and foremost, I am an economist, and I apply economic indicators to what's going to happen with the stock market. So understanding 2024 stock market analysis means understanding what's going to happen with the economy. If you understand that, you have a good idea what's going to happen with interest rates and how that will affect the stock market for 2024. Let's jump in. I'll show you what I'm looking at. If you're just joining me for the first time, thanks so much. Make sure to hit the like and follow down below. I just launched this channel and it's growing quite rapidly. Thanks so much to all those who are supporting the channel. What I do here, first, I'm D.H. Taylor. I am an economist, and I break down economic indicators and show how that applies to, say, the Federal Reserve's activity, and then how that applies to the stock market. I look at the various aspects of the broader stock market. I'll look at oil prices, gold. I'll look at the semiconductor industry, the retail industry, things like that. So if that's what you're looking to understand, make sure to hit that like and follow button. In the meantime, to understand the 2024 stock market analysis, if you want the 2024 stock market projections, what you need to understand is, what is the Federal Reserve going to do next and why? That's the big question. And right here, we're looking at the Federal Reserve effective rate. The Fed funds, what they do is they target a certain area, and they'll give you a range like 5.25 to 5.5. Then there's the effective. What did they achieve? The New York Fed Bank is the one that actually does all the dirty work down on the floor, doing whatever they need to do. Here we're looking at the federal funds effective rate. And as you can see, we've pushed up pretty quickly over a short period of time. We've done it before. We've been here at these prices before. And everything is all about what's happening with inflation. But beyond just core inflation rates, what individuals are paying, another thing that the Federal Reserve is really going to be focusing on is the M2 money supply, and I do have charts for that. Here it is, M2 money supply. As you can see, we saw a big jump higher in 2020 because of COVID shutdowns. The Federal Reserve walked in and just threw cash all over the place. They did so providing enough liquidity to ensure that the financial system wouldn't in any way whatsoever seize up. We're a fractional banking system. So by the Federal Reserve stepping in and buying up U.S. Treasury debt, this freed up other individuals to buy other debt to keep businesses moving forward. The Federal Reserve just gobbled up as much as they could. They pushed interest rates as low as they could so that there would be no sort of hesitation within the financial sector because of the COVID shutdowns. Well, we can see what they did to the money supply. All that money supply fuels inflation. It's one of the aspects of what's going on. Of course, we have the war in Ukraine and the aftermath of all the sanctions on Russian oil and things of that nature. We do have a supply chain that was broken up to some degree. So there's a lot of factors that are playing into why interest rates or inflation rates shot up higher, and you need to understand that for the 2024 stock market analysis. Now, here is core PCE inflation deflator, personal consumption expenditures. It's one of the core things that the Federal Reserve looks at. It's an inflation indicator just like CPI. We get the CPI usually about 2 weeks before we get PCE inflation deflator. This indicator looks at three things. First, personal income. Second, personal consumption. So you have income, and one thing that the Americans can't really do a whole lot of is save income. They spend it. So the rate of growth of income is going to drive the rate of growth of expenditures. Baked within that, as expenditures move up or down on an annualized year-over-year basis, that will push inflation up or down. If the economy were to contract significantly, prices are going to drop. What would drive the economy to contract significantly? Incomes drop because of unemployment levels jumping up. Therefore, consumption drops. These are principles that for the 2024 stock market analysis, I'm baking this in as to the core concept, what's going to happen with the consumer. We're going to be looking at some numbers there and how that affects inflation, but it still goes back to money supply. M2 money supply is way too high. They need to bring that down to a more trend line basis. Here is personal income. Again, I just mentioned this. What you're looking at is the year-over-year growth rate for incomes. If you want to know what's going to happen with consumption, which is 70% of what drives the U.S. economy, first thing you look at is what's happening with incomes. We're starting to see a little dip here, or sort of a peak that is now falling lower. Will incomes continue lower? Two things drive incomes going lower. First, unemployment. If you have a set number of people that are employed and earning a certain amount of money, and all of a sudden 1% of those individuals loses their jobs, that income is no longer considered for personal income. Simply put, it's gone. From that, the rate of growth of incomes would begin to drop. We're seeing increases in unemployment. The next step in this is, how does that affect consumption? If incomes drop because people are losing their jobs, expenditures drop. Now, if you look at that green line, you can see towards the very end there, the little dip that we're seeing on personal incomes. Personal expenditures haven't really caught up. The charts are a little distorted because of all the things that were going on with COVID. Huge money showing up through stimulus checks and things like this, but we're getting back to a normalization from that. And with income moving slightly lower, I'm expecting expenditures to kind of follow suit. And therefore, I'm expecting inflation to follow suit. But that doesn't necessarily mean that the Federal Reserve is going to immediately drop interest rates. M2 money supply. They've got to get the money supply more trend line. Here's another thing that you want to kind of take a look at. What kind of situation is the consumer actually in? Not only are they earning at a slower pace because we're seeing some unemployment hit, but consumer debt as a total percentage of income is starting to move a little higher. Of course, we've been much higher, and if you look, this was sort of right before some recessions. We could easily see this continue much higher, but here's the delinquency rate. So it's not just debt to income, it's the rate of delinquency. This is certainly starting to move back upward. Of course, the 2008, 2009 housing crisis, the delinquency rate, of course, shot way up. So that's a little distorted there, but we're starting to move up into a more sort of midline area. Here's the same two charts, consumer debt as a percentage of total income in the red at the top versus delinquency rate, and you can kind of compare that. So basically what this is showing is we're seeing the consumer with high levels of debt relative to income and increasing. Also, the delinquency rate is moving higher. During a period of time when personal incomes, which would drive the economy from personal expenditures, is starting to really kind of weigh on overall picture for the consumer. So if you're looking at the 2024 stock market analysis, you want to factor all these things in. What shape is the consumer in? They drive 70% of this economy. They're starting to wobble. The consumer is starting to wobble a little bit. Continuing claims, starting to see this move back upward. But let's put that into perspective. Here's the same chart, starting to move back upwards, but we're still a long way away. So how far up will continuing claims move higher? Will we see this all through 2024? Are we going to see this shoot up higher, or is this just a hiccup? And understanding my perspective of the 2024 stock market analysis, I'm looking first and foremost at this number right here. This is the one I'm really kind of focusing on. If we see continuing claims move higher and higher and higher, that spells a big sell-off for the stock market. But what I think is likely to happen is continuing claims moves up somewhat, levels off, and starts falling right back down again. I do not believe that the Federal Reserve got it right. They never do. So my 2024 stock market analysis, I start with the fact that the Federal Reserve didn't get it right. We're going to see some contraction in continuing claims. This will affect incomes, which will affect expenditures. That means less revenue for companies. A little bit. Continuing claims move up a little bit. It's a lagging indicator. But then we start to see sort of a mellowing out, and then inflation not going down to 2%. The Federal Reserve has to step back in, probably later on in 2024. So your 2024 stock market projection must entail that the Federal Reserve did not get it right. They're likely to have to push interest rates higher. They're first and foremost going to try and get M2 money supply trend line. Then they're going to have to also push further to get inflation lower. Here's the look at the U.S. 10-year Treasury yield. This is the benchmark Treasury rate. You kind of compare this to all investments out there. Right now it's about 4.47%, 4.5%. That's your basis for your investment. Now, one of the things I do is I break down individual stocks. So when I look at any kind of value investment, the very first thing I asked is, given the next 4 quarters, what would this particular stock produce in yield? You look at the future 4 quarters earnings per share, divide that over the current stock price. I'm seeing yields of like 2.5%, 3.5%. That's kind of where a lot of these stocks are. My take, you've got the 4.5% out of the U.S. 10-year Treasury versus an investment in a stock that's only pushing out 2.5% to 3%. You're more than likely inclined to hit the 4.5% benchmark rate with very little risk. You're baking in 4.5% over the course of the next 10 years. If the Federal Reserve has to push interest rates higher, of course, no, you didn't pick the very best possible point to get in. But eventually the Federal Reserve is going to have to lower interest rates. So your 4.5% all of a sudden looks real sweet once the Fed pushes interest rates lower to the point where the 10-year is below 4%. Then all of a sudden you can sell that for a lot more money versus your stocks that are yielding 2.5% to 3%, maybe 3.5%. That benchmark measurement is really going to come into play with the 2024 stock market projection. If these stocks continue to be elevated above a price point where the benchmark is yielding higher, savvy investors are going to get out of those stocks and opt for the 10-year. The risk-reward ratio just dictates that they would. So for the S&P 500, the 2024 stock market projection, I think we probably move sideways, lower. As long as the Federal Reserve keeps interest rates exactly where they are, the U.S. 10-year benchmark outperforms a lot of stocks. Savvy investors are going to get out of those stocks because there's too much risk with very little reward, especially if the economy contracts mildly. Given that, the S&P 500 probably starts to move downward all through springtime. mellows out throughout the summertime, but we might see things start to get really kind of ugly going into the fall. And for the 2024 stock market analysis, that's what I'm really looking for. Is we'll probably move sideways to lower in the first part of 2024, then much lower towards the end of 2024, because I believe that the Federal Reserve is going to have to step in and raise interest rates more. So my 2024 stock market projections were much lower towards the end of the year. I was pretty accurate with last year's stock market projection. On the one hand, I really hope I hit it right. On the other hand, that would kind of suck. But that's the stock market. That's what we're looking at. If you're just following me for the first time, make sure to hit that like and follow button. Hopefully you can see what I'm looking at for the 2024 stock market projection and analysis. I'll be updating this throughout the year, adding more information as we get more information on the economy and how this will affect the 2024 stock market analysis. Make sure to hit that like and follow button. We'll see you in the next video.